Richtech Robotics, symbol RR, not to be confused with Rolls-Royce, builds services robotics for hospitality, retail, and healthcare. Think robot bartenders, servers, and cleaners. Their products include Adam, the robot bartender, and Guardian, the cleaning bot. And as a side note, I was recently at a Walmart in Fresno and I saw this robot actually doing cleaning. I wish I'd taken a video of it, but I don't know, it might have been them. They're shifting from one-time sales to robots as a service, RaaS model, which is a new term to me, leasing robots and collecting recurring revenue. What makes this a cool idea is there's a labor shortage and automation trends are driving huge interest in service robots. When you look at a country like Japan that has an aging demographic, they just don't have enough people to do these service jobs. Richtech has early partnerships, probably Walmart, and a new joint venture in China. They have strong gross margins in the 65 to 75% range, which show that if they can scale, they have a real business on their hands. But right now, they're still very unprofitable and no proven moat, and face massive execution risk. In 24, revenue dropped hard to 4.24 million, down 52%. After pivoting to the subscription model, Q3 25 revenue was only 1.18 million, down 18% year over year. The good news is there's some deals in place. There's a 4 million sales agreement in China and a master service agreement with a top US retailer, Walmart probably, but both are early stage, future potential but not guaranteed revenue. So gross margins are elite, but operating costs exploded. In 24, Richtech lost about 7 million operating and 8.1 million in net earnings. Each quarter of 25 is still losing around $4 million. They hold around 30 million in cash and short-term investments with almost no debt, which have great liquidity. However, they filed a $1 billion shelf registration and made a $100 million ATM equity program. That means dilution could be coming if they sell shares to fund growth. Insiders are buying shares to inspire confidence. The CEO himself bought shares. That's always a great sign. Their biggest problem is the competition. Richtech is battling giants like ABB, Fanuc, and newer robotics players such as Bear Robotics and even SoftBank Robotics. So robotics may go the way of dishwashers and other productivity appliances where they're sort of indistinguishable to their customer. And they rely on China for manufacturing key components, and that's a problem if the Chinese decide to compete, and this seems like a space they will compete. My discounted cash flow analysis suggests a base intrinsic value of roughly $3 to $5 per share. Even my bull analysis with huge growth, 20% margins, reaches only $8 to $10 per share. For context, RR trades around $7 a day. That's over 100 times sales, while robotics peers trade at under 10x. And there's not really like a short squeeze potential or one of these meme stock events possible because there's not a huge short interest in this company. This is not investment advice, and YOLO.